Good afternoon and welcome to Bloomberg Quint Live. I'm Alex Matthew. Here are the headlines. Indian markets trade completely flat on the last day of the week. And it has been a flat listing for the new kid on the block, Mahindra Logistics. It debuts with a marginal uptick. SBI, Bosch, M&M and BPCL, the four big earnings that the street will be watching out for, will come out in a short while from now. The GST Council gets set to review the tax levied on as many as 200 items and expand the ambit of the composition scheme later in the meeting today. Now, Indraprastha Gas has reported its second quarter earnings, and that just happened yesterday, and seemingly steady as she goes. We've got the company's management here, and Somit Sarkar, who tracks the space closely, will drive that conversation. Somit, over to you.
Thank you, Alex. Now we are joined by the Managing Director of Indraprastha Gas, E.S. Ranganathan. Mr. Ranganathan, good afternoon. In the second quarter, your EBITDA per standard cubic meter declined to 5.9 rupees. What were the reasons for the same?
Yeah, actually, EBITDA, we are, targeting something between 5.5 and 6. So this quarter, we were delayed. We were a bit late in including the effect of GST in the cost by around 20-25 days. That's why the EBITDA has come down.
What is the kind of EBITDA per SCM that your investors can expect in the second half of financial year 2018?
Yeah, it will be in the same range, between 5.8 and 6.
What was the impact of GST in the second quarter?
No, when the GST comes, we don't get input credit for whatever GST we pay for our equipments as well as gas and transportation charges. So that has an impact on the cost of operations. So we have passed on the cost to the customers, but we were a bit delayed by 25 days.
So what was the financial impact of this delay?
Something around 12 to 14 crores.
So in the second quarter, your total volume growth was healthy compared to last quarter, but surprisingly in this quarter, PNG volumes grew at a faster rate on a Q-on-Q basis if you see. So do you expect similar trend going forward?
Yes, actually the industrial sales has been good, and we going forward because of the Supreme Court banning petcoke and furnace oil, we expect to get more industries into the gas fold. We are in touch with at least 120 industrial concerns, and we expect to bring all of them on board by end of this year.
Okay, many thanks for that, Somit. Let's just address the Bosch numbers that have just come out. The only number that we have right now is the net profit, which is coming at 350 crores versus the estimate of 440 crores. So that's a miss as far as bottom line is concerned. But I would rather look at the top line and the EBITDA to give an indication of what exactly is happening. So that's what we have as of now. The Bosch stock down almost 3%. Seems the numbers will be really weak. Okay, Somit, we'll come back to Bosch, but let's continue with the management of IGL.
So continuing with you, Mr. Ranganathan, at what rate are you expecting the industrial and commercial demand to grow?
Total potential demand is for the extra new consumers is around 100,000 SCM per day. So that will be something like, adding to the 500,000 that we are doing now.
How much incremental demand would come in from addition of new areas like Gurugram, Rewari?
Yeah, we expect addition of around 100,000 in Rewari once we commission our pipeline by end of this month, and then we will start operations. The first stations will start operating in Gurugram and Karnal also in the Q4.
You're also looking to buy out your JV stake in Central UP Gas and Maharashtra Natural Gas. By when do you intend to complete these acquisitions, and by how much your incremental volume would go up from these acquisitions?
We are in touch with the promoters, and right now the way they are going in the next 5 years, MNGL and CUGL should touch combined volume of around 1.6 million.
By when do you intend to complete these acquisitions?
It depends. I cannot give a definite date right now, but we will definitely do CUGL first, and then we will go for the MNGL in the next year maybe.
Thank you, Mr. Ranganathan. That would be all. Thank you for speaking to Bloomberg Quint. And now it's time for Hot Money. with Darshan Mehta.
Thanks, Amit. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Joining us on the show today is independent investment advisor Vivek Mamani, Urmil Shah of IDBI Capital and Savi Jain of 2.2 Capital. The stocks that we'll discuss today on Hot Money are Page Industries, Maharaja Batteries, Indiabulls Housing, Pidilite and Aurobindo Pharma. Let's talk about the first stock, and that is Page Industries. Was one of the top gainers in trade yesterday. Today it's trading rather flat in trade, but multiple at all very extremely high, trading at a very high multiple of almost 60 times FY19 earnings. So what should one do with this stock? Should they chase growth, or is valuation a concern? We'll ask our guests. I'll start with you, Vivek. Any view on Page Industries?
Well, the view is it's an excellent long-term brand franchise which has consistently over the last 10-12 years since the time it's been listed, quarter after quarter delivered consistent and sustainable growth, 40% return on capital, return on equity, quarterly dividend payouts. I mean, probably one of the rare companies to do that in India. But yes, every good quality comes at a steep price, and Page at about 60 times or 70 times current year and the following year earnings is certainly not cheap. But this stock at 1,000 rupees few years ago did not look cheap, at 2,000 didn't look cheap, 5,000 didn't look cheap. At every point it had been expensive throughout the last 10 years. If really one were to look at valuation by strictly the value investing, I mean the way Warren Buffett or Ben Graham kind of formulas, if you were to get into, so long as quarter after quarter 20-25% growth is sustained, I don't see a serious downside for the stock from current levels of 22,000 or that it is trading at. So that serious contraction of multiples may not happen anytime soon till the time that they disappoint on the earnings. So it's I would say it's a buy on declines for a long-term holding, buy and forget kind of a core portfolio holding. And you don't really need to worry about the valuation so long as the growth is flowing in.
Okay. Savi, valuations back almost at a 2-year high again now at 60 times on a forward earning basis. What's your view on Page? Is it expensive? Would you buy this? Would you recommend someone to accumulate this counter, or would it be better to stay away?
Yes, I would agree with Vivek on most of the points. It's a very good quality franchise, and it is, despite such a large size, it is still growing at 15-20% year on year, and that's commendable. It's still gaining market share. A lot of competitors have come and go, but nobody has been able to make a dent on its market share. And that's because it has built a very strong moat around itself, be it in the form of control on the product design, product innovation. It also controls the quality of the product because it controls the manufacturing process as opposed to its peers like Rupa or Lux, who outsource most of the manufacturing. It has one of the most extensive distribution network, very innovative branding tactics, etc. So these are moats which cannot be eroded in a jiffy. So in that sense, it's a great franchise, great company. Also, it has been able to diversify away from men's innerwear to women's innerwear and leisure wear, which already contribute more than 50% of its revenues. And that's growing at higher than the men's innerwear segment. So the growth drivers are there. But like Vivek said, that if I have to look at it from a Ben Graham philosophy of value investing, which is what we do, then at 70 times FY19 or 60 times FY18, it definitely looks very expensive. It obviously, it keeps giving dividend, 50% of its profits as dividends, because it has a 50% ROE. It's growing only at 20%. So there's a lot of extra cash that is generated, which is given out. There were some issues of growth in 2016, so these kind of things can keep happening. So it's not like they're going to continue to grow at 15-20% for the next 20 years. So in that sense, I would be slightly skeptical on the valuation. So therefore, I'm neutral on the stock.
What about you, Unmil? What's your view on Page Industries?
Very less to add to this views. Clearly, one of the best B2C plays. If somebody has to do that, then of course it's a buy. But otherwise, we would recommend a kind of hold if anybody already has in the portfolio, because we also believe that there are other opportunities with similar growth and entry barriers available, not necessarily to pay a 60 times FY19.
Okay, so that's the view that's coming in on Page Industries. Vivek is bullish on the counter. It's a long-term hold. But the other two guests, Savi as well as Urmil, do believe that, it's more, at this point of time, valuations looks a little stretched. If someone's holding it, they should hold on to the counter. Let's talk about the next stock, and that is Maharaja Batteries. Numbers came out yesterday. Pretty strong set of numbers, and the commentary in the conference call was also decent for the company. What should one do with Maharaja Battery? Because valuation wise it's slightly more expensive than Exide, but in terms of return ratios, yes, they do command a better return ratio. So what should one do? Stick with Maharaja or move to Exide? Savi, I'll start with you.
So, I don't follow the space very closely, but, one structural change that we are seeing is the advent of electric vehicles. Now, in that context, how do you see Maharaja play that entire space, or even an Exide for that matter? So that's a big unknown, and this is something that is going to accelerate over the next few years. The government has a lot of thrust on this space. Now they can get into manufacturing lithium-ion batteries, etc., and then also capture a share of that. But there are a lot of risks there. One is that the OEM themselves may end up manufacturing these batteries. Then how does Maharaja remain relevant in that sense? So I would watch the entire tech disruption that is happening over the next few years, and therefore avoid investing in something like an Maharaja. From a medium term, there are a lot of tailwinds like GST, etc., because of which there's a shift from unorganized to organized. But if you have to value the company, majority of its value lies in the future growth, all of which is at risk probably due to the electric vehicle.
Urmil, do you agree that there are a lot of headwinds yet for battery makers?
We actually believe that there are a lot of tailwinds, and more so for Maharaja, because we need to keep in mind that Johnson Control is one of the best as regards on the technology side, for batteries are concerned. And they hold 26% stake in the company. So we are extremely confident that Maharaja should be able to capture the opportunity that comes in electric vehicles over the longer term. In the medium term, of course, as regards the telecom segment, the growth has come off, and they are not very strong as Exide in the OEM space, the vehicle space. But clearly, we believe that a company is well placed to take advantage of the shift to the organized play, and over the long term on the electric vehicle side. So we are very positive. In fact, we have a target price of 940 on the stock.
Okay, that's the view. So one bullish view, one bearish view. Which side would you be on, Vivek?
Well, I would avoid Maharaja at this point of time, and I'm not venturing into very long term, as Savi mentioned about electric vehicles and technology disruption. One really doesn't know what's going to happen 5-10 years down the line, so I'm not really even hazarding a guess at this point of time. But another correlation, if one could draw, is battery stock prices and their performance and lead prices seem to have an inverse correlation, and you could actually map that on a quarter by quarter. So with a quarter that commodity prices are high, they tend to have little margin squeeze where the price adjustments happen little with a lag effect, and stock prices do tend to underperform during that period. So I would probably take more than the top line in terms of growth. What are the growth opportunities? I would look at the cost side of it as to whether we are going to see expanding margins in the next few quarters or not. And there, I think there could be some pressures building up over there as far as Maharaja is concerned, where the metal prices seem to be on an uptrend. At 30 times valuation current year, I don't think by any yardstick it's cheap. This is not a consumer franchise that we are talking about, the likes of an Asian Paints or a Nestle or a Marico Dabur. It's certainly not that. But if it's going to be, if it has valuations of those types where growth itself is cyclical companies can't be trading at such high multiples. I would never want to pay that kind of prices. So I would clearly say it's an avoid, even if there is growth where in the long term there is potential for growth, where promise and all that. Let's see when we come to that. The stock has, in a bull market, corrected by more than 30% from its 52-week highs. So obviously there is a reason, and I don't see it going back to those levels any time soon. Probably over a 12-month or a 2-year time period, it may go back to 1,000. But I would say it's clearly an avoid. There are better opportunities to look at in the market.
Okay, so that's the view that's coming in on Maharaja Batteries. Savi as well as Vivek are not at all bullish on the counter. Urmil shares a different view. He is bullish with a substantial higher target price on the stock. Indiabulls Housing Finance is the third counter. A lot of block deals happening. The counter has been buzzing over the past few days. What's in store for Indiabulls Housing Finance? Let's ask our guest. Urmil, I'll start with you. Any view on Indiabulls Housing Finance?
Yeah, so we are clearly positive on this company. If you look at short term, medium term, long term, performance of the company, they have delivered 25% CAGR in advances, NII or net profit on a very consistent basis. Stock also provides a 4% dividend yield, so the payout is also has remained very strong. And if one has to play the affordable housing opportunity in India, Indiabulls Housing clearly is a very one of the best plays available. We think that a 25% CAGR is sustainable for the next 3 years at least. And keeping that in mind, the stock is trading at 3.2 times price to book on FY19 basis. So given the opportunity available, we believe that this is clearly a buy.
What about you, Savi? Any view on?
So we are very negative on the housing finance space, given what is happening in the competitive landscape. We see a lot of new players which have entered in the last 4-5 years, be it all kinds of NBFCs and their subsidiaries of gold finance company, of microfinance companies, small finance banks, large diversified financials like IIFL, Edelweiss, Motilal Oswal. Everyone has become very aggressive on this space. On top of that, corporate credit is not growing, so all the banks are pretty aggressive, both on the rates and the yields, because of which the NIMs are compressing. Now, if you look at some of the peers like Canfin or Group Finance, HDFC, and some of these players, the NIMs are already compressing. The stocks have come up from their lifetime highs, and the growth is also tapering off. So that's the supply side, and then on the demand side, because of RERA and GST, new buildings are not being constructed, and therefore the demand may taper off in the future. So all in all, we see issues both on the demand side and the
for all NBFCs as such, for all housing finance companies.
Yes, for all housing finance companies, Indiabulls has been growing significantly. Maybe some of the NPAs because of the base effect, lot of the loans have not been seasoned enough for the NPAs to come through. That is something that we'll realize probably in the next few years. And Urmil mentioned one point about 4% dividend yield. That is actually for me a negative, because the company did $1 billion QIP, raised capital from investors and then paid 20% DDT on it and then give it back to the shareholders. Kind of does not make sense to me. So in that sense, that's a negative for me. Overall, I am negative on the stock.
On the stock, okay. What about you? One negative, one positive view?
Well, I'm not particularly negative either on the sector, although I do agree with some of the points about housing finance mentioned by Savi about PSU banks getting more aggressive, and everybody and his uncle's NBFC is now in the housing finance space. The sector no doubt will continue to grow at maybe 15% sectorally. Indiabulls Housing Finance has displayed higher growth in the last 5-7 years. But a couple of other points which I may add as far as Indiabulls. I mean, Indiabulls Housing Finance has a large loan book to the developers as well as LAP, loan against property, which as he covered are not seasoned enough. So maybe some of those or a large part of those could be NPA pipeline building up, which may probably come in the next 12 to 24 months. That's number one. Number two, I'll straight come to valuations, since the other points have been covered. At 4 times price to book current year, HDFC also is at 4 times price to book, so is Indiabulls Housing Finance, and then there is that ends the argument as far as quality is concerned. When you go with the biggest, the best and the oldest, where you don't have any other issues to deal with, you also have a value unlocking up which is happening in HDFC, which will happen over the next 2 years in terms of large number of subsidiaries and associate companies where HDFC has large investments. So at 4 times book, for me, HDFC itself is preferable, Housing Development Finance Corporation, than to venture into Indiabulls.
Okay, so that's the view that's coming in on HDFC or Indiabulls Housing Finance at this point of time. Savi is indicating the fact that he is bearish on the entire housing finance space. Vivek is saying that HDFC makes a better bet, and finally Urmil does believe that it's a good bet because it is growing at a significant pace and gives a good dividend yield. The next stock that we'll talk about is Pidilite. The company came out with a very strong set of numbers in the sector, consumer sector, pretty much one of the best numbers that it displayed. Does it have room to grow more? I'll start with you, Vivek. Any view on Pidilite?
Oh yeah, excellent. Again, an excellent brand franchise. It's a terrific business where they have created serious moat around themselves. I mean, among the very few companies globally one can see who can sell industrial products, B2B products in a branded manner, get a price premium and get a superior margin on a like-to-like basis. I mean, simple thing is that adhesives or industrial chemicals, that's one part of it. Extremely good capital allocation and excellent balance sheet. Return ratios in excess of 20%, close to 25% for the last, if I can recall, at least 15-20 years. Steady margins, growth of about 12 to 15% on top line, 15 to 18% on the bottom line. So basically they tend to get better product mix and higher margins. And very strong innovation pipeline in terms of new products. Valuations coming to that at about 40 times current year earnings, maybe about 32, 33 times FY19 earnings, again may look slightly expensive, but if we were to look at comparables, I mean, where here are comparables I'll look at as an Asian Paints or any of the other FMCG companies, it's comparable. You pay little premium for consistency, sustainability of growth, superior balance sheet, cash flows, dividend payouts, all of it is in favor of Pidilite. So it's a terrific long-term portfolio holding stock. You can buy on declines, any market panic corrections. Pidilite is a good company to accumulate.
Do you agree, Urmil, on the reasons that Vivek is indicating?
Yeah, I agree on almost all the points that Vivek has indicated, and clearly any sort of weakness in a particular quarter. If you look at Pidilite's stock price performance over the last 5-10 years, any kind of weakness in a particular quarter or is a very good price to accumulate the stock. So according to us also, this is a kind of must have in a long term portfolio, and any portfolio which has to be built for compounding stories. So we are also positive.
Okay, so two positives on Pidilite. Savi, any view on Pidilite?
So I agree with most of the points relating to the business, and if you already have it in your portfolio, I think you should not even consider selling it. But to buy it afresh is something I'm not sure about.
Why? Because of valuation, or
it's also headroom for growth. The segments that it is in, it is by far the market leader. So adhesives, quick adhesives, sealants, etc. It already has 70% market share. This is not a segment where a lot of unorganized players are there. So that GST tailwind of unorganized to organized, that is also not going to happen. So essentially, this company is going to grow at probably a multiple of the nominal GDP growth. So, and that would mean maybe a growth of 13-14% over the next few years or for the next many years. So there's no scope for market share gain. Probably it could lose some market share if Asian Paints, which has already become active in the adhesive space, it may try and get some of the market share. So overall, I'm neutral on the stock because of the valuation. It's, I think, trading at close to 50 times FY18 earnings. So in that sense, it's definitely expensive.
Okay, so that's the consensus view that we're getting on Pidilite. If you own the stock, it does not mean that you should sell the stock. You should just hold the stock. That is what all our experts are indicating. Both Vivek and Urmil are bullish on the counter. Savi does believe that valuations at this point of time is expensive, not too much of a headroom currently. And let's move on to the final stock, and that is Aurobindo Pharma. The counter is down almost 4%. Post the numbers that came in because the internals look weak. The management commentary today was not one of the strongest. What should one do with an Aurobindo Pharma? It's one of the cheapest stock in the pharma space. Does it deserve a higher multiple? Should someone buy into the counter? I'll start with you, Urmil. Aurobindo Pharma, any view?
Yeah, so the numbers were weak. There is nothing taking away from that. But we believe that if you actually take a medium to long term view, this has been one company which, despite having a US exposure, has been the least impacted as regards the headwinds from the pricing front. Because they do not have a very heavy exposure on one or two drugs. And also if you look at the ANDA approvals which are pending, they are more towards the complex product side. So that should mean that FY19 or 20, the margin should improve going forward. And if you look at their strategy on M&A, they are also looking at growing in the European side. So that should help the growth in FY19 and 20. So given this scenario, and as you mentioned,
But why doesn't Aurobindo get a higher multiple? What seems to be the issue?
So I think it's to do with the corporate governance. Last year there was a ED charge sheet on the promoters for colluding with the Chief Minister of Andhra Pradesh, and I think that is a huge overhang on the stock. I agree with Urmil that the business is fantastic. The US business is probably, it is one of the largest players, and as compared to its peers, it does not have issue on the manufacturing sites in terms of regulatory issues. It has one of the most largest number of ANDA filings because it started way back in 2013. So it has one of the lowest R&D costs because it already has a huge pipeline of drugs. Only 4% of their sales is the R&D cost as compared to say 10-11% for some of its peers. So therefore profitability.
No, but that was the big concern because R&D cost this time around was 3.5% when usually it does 5%. Yes. And that is why the margins also looked optically higher.
Yes, so what Aurobindo probably, if Aurobindo's answer to that is that I already have one of the most robust pipelines. They started way back in 2013. Their R&D costs were much higher at that point of time. So they did a lot of filings then when no one else was doing. So they already have a huge pipeline of drugs, and the European business is doing good. So overall, the businesses are good. It is not so strong in the Indian market, which is one clear negative because that is one defensive business that can support the regulatory headwinds that are there in Europe and US. So it's because of the corporate governance, and that is why even we would avoid something like that.
Vivek does not cover Aurobindo, so I will not ask him. But that's the general view that's coming in on Aurobindo Pharma. Urmil is bullish on it, but some bit of corporate governance issues will keep Savi at a neutral. With that, it's a wrap on today's Hot Money. Thanks for watching Bloomberg Ping. Thank you all of you for joining us.